Hi, everyone. This is Jason Barrack of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's an energy expert and an engineer in the energy field, Robert Rapier. So thank you for joining us again today, Robert.
Thanks for having me on, Jason.
Now, Robert, you recently wrote an article for the Energy Trends Insider about the natural gas inventory. So we've had a really, really cold winter all over the United States. We've had this crazy polar vortex. It's done crazy amounts of usage for the natural gas. Just tell our listeners kind of brief summary of what's gone on in the natural gas market, maybe that most of the herd did not see coming.
Yeah, so basically there are two things in natural gas. I've been predicting higher natural gas prices for a couple of years on the basis of some long-term drivers like LNG export terminals coming online and then the EPA essentially outlawing new coal-fired power plants with tighter regulations on carbon emissions. So longer term, I think the drivers are toward higher natural gas prices. A lot of drilling rigs have shifted out of natural gas drilling over into more lucrative oil drilling. And so those drivers are all, in the long term, they're favoring higher prices. So the last 2 years, I predicted the average spot price of natural gas for the year would be higher than it was the year before. And I made that same prediction this year, but I warned in the short term, weather events can always override those long-term factors. So if we have a very warm winter, that can override that long-term, what I think is a bullish trend on natural gas. But this year, instead, we had a very cold winter. And what happens is in the natural gas markets from about April 1st, give or take a couple of weeks, until around the 1st of November is injection season. This is when demand is down a little bit, and the U.S. has a lot of storage, natural gas storage in caverns and depleted oil and gas fields. And natural gas inventories are built up during the year across the summer. And then starting about the 1st of November, when it starts to get cold, these inventories get depleted. And interesting situation in 2012, we had a very warm winter. And if you recall, that's when natural gas prices collapsed. They bottomed out below $2 a million BTUs. And the reason is that the natural gas inventories were still in very good shape at the end of winter. And so we went into injection season already in very good shape. And so natural gas prices fell. And that depressed natural gas prices for over a year. They didn't recover for a year. This winter has been different. There are a couple of unique things about this winter. This has been the fastest drawdown across a winter in history. We've had inventories at lower levels, so we're not yet at the lowest record, but we started this winter at a much higher level than the current lowest level on record, which happened in 2003. But we're just another cold week or two away from being at that lowest level on record. But regardless, we are way below the 5-year average band for storage. And so what that means is we're going into injection season at a serious deficit. Historically, what that means is we're going to be racing to try to get inventories back into good shape by fall. And that means natural gas producers are going to be producing as fast as they can, and it means natural gas prices are going to be higher than they were. So my prediction on higher natural gas prices this year, like I said, they're based on long-term factors, but the winter has pretty much assured that prediction is going to end up being correct regardless. And so there's money to be made in natural gas producers at the moment because, interestingly enough, some of those have sold off on the expectation or an announcement by some that their production would be flat for the first half of the year, in some cases because of the cold weather. But the EIA just released a new short-term energy outlook, and they've now increased their projection of average natural gas price for this year up by 6%. So they're projecting $4.44 for the average price for the year. Last year's average was $3.73. So that's going to benefit natural gas producers. If there's an upset, if there's any incidents, the spike will be to the high side. We've already seen a couple of spikes high. We haven't seen any above $10 yet, but in the past, when we pulled inventories down this low, we did see spikes above $10. So I'm not predicting that we're going to run out of natural gas, and I'm not predicting that gas is going to go to $10 and stay there. But if we do have another cold winter, if we go into another winter like this one, we're probably looking at much higher natural gas prices because it's going to be very difficult for us to keep inventories where they need to be. And you will see some rigs start to flip back over from oil into gas, but you're going to see some profits for natural gas producers, and you're going to see some pain for consumers who are heating with natural gas.
Now, that's very interesting. Now, at the beginning of the year, we did Wall Street for Main Street some predictions for the commodities market and other markets and stuff like that. And I expected natural gas, based on the long-term fundamentals, much like yourself, to just staircase higher. But I didn't see, this once in a generation almost cold front that has come, because we've had the Niagara Falls freeze over, the Great Lakes basically freeze over. These are things that really haven't happened in since the 1860s or 1870s in some records. So it's just been a really interesting thing. And you mentioned the natural gas producers, but what about the infrastructure plays? Is there a lack of storage capacity then for natural gas, or are we just not using it properly, the natural gas properly? Have people not switched over to natural gas like the chemical companies to make plastics and things like that?
Well, you're correct in that there isn't sufficient infrastructure in some cases. Like Cabot Oil and Gas, for instance, a major natural gas producer in the Marcellus, in the Utica, they lack enough infrastructure to get their gas into the major markets. And so they are selling their gas at a discount to some of these very high price spikes. And you do have infrastructure builders like Chicago Bridge and Iron. They're building out a lot of this infrastructure, and they're building out infrastructure for LNG and the petrochemical boom. So natural gas producers will benefit, but the infrastructure builders also are in a very good position. Not all the gas producers are created equally. Some of them are like Cabot, I think, for a long term is going to do very, very well. But they announced that they're switching over more to pad drilling this year, multi-well pad drilling. They said our production is going to be flat in the first half of the year. Well, they peeled off about 10% when they announced that. The Cabot did well last year. I think they'll do even better this year. But now their price just dropped about 10%, and so you can get them at a little bit of a discount. Devon Energy, Chesapeake. Chesapeake was one that I picked last year that ended up doing very well. I picked that one in about April. I said I think it's time. I think Chesapeake is in pretty good shape. I think it's time to start to buy some of these natural gas producers, and Chesapeake did quite well for us.
Now, transitioning a little bit from regular natural gas production to LNG, do you think that too many natural gas LNG exporters are being approved, and that could potentially crash the price? Because isn't so much of the LNG market right now, a lot of it's Japan, or do you think that more other countries will do deals like with Cheniere and those types of companies will lock in contracts? Because with Cheniere, we've seen, most of their contracts, once their plant is online, are not going to be with Japan. They're going to be, spread all out all over Europe and Asia. Do you think that once the supply is there, that demand will come, or do you think that too many LNG export facilities are going to be built in the U.S.?
Yeah, right now the amount that have been approved or in process by the DOE is equal to about half the total natural gas production in the U.S. Those aren't all going to get built, but they have to also be approved by the Federal Energy Regulatory Commission, FERC, and the only one that has been approved by both is Cheniere. And there are several that are the DOE approval process is much less taxing than the FERC process. When somebody goes to the trouble of applying for approval with FERC, they're serious, and they're much more likely to get built. You're correct. There are a lot of them that are on the drawing board. Cheniere will definitely go, and they are doing contracts all over the place. Japan is the really lucrative market, but in the long run, Australia is probably going to end up being very, very competitive in supplying that market and supplying Southeast Asia. But I think enough will be approved in the U.S. that it will drive natural gas prices. It will put a $1 or $2 premium on natural gas prices over the next 5 to 10 years. And
yeah, and I don't think Japan can afford all these expensive LNG exports continuously, because they went from running trade surpluses to enormous trade deficits, and those trade deficits are almost solely because of their energy import costs just spiking rapidly, after Fukushima. And, they have a lot of other financial problems, and one of the main reasons they installed nuclear reactors in the first place in the 70s, right, was because they had a energy import crisis when the oil prices in the 70s spiked from, $3 a barrel to $30 a barrel at one point. So, I just don't see, if you're an LNG exporter here in the U.S. and you're relying solely on Japan, you're not building a long-term sustainable business model, in my opinion.
Yeah, Japan has some difficult decisions to make, and they're already making noise about, we really are going to have to rely on nuclear power despite Fukushima. And Germany is going through some of those same difficult decisions that, that phase out of nuclear power is going to be costly in a lot of other ways. So, but Japan's not the only game in town. I mean, there are some pretty high premiums being paid for LNG in Southeast Asia. Europe is not quite as lucrative, but for East Coast of the U.S., that's not probably a bad market for them. They're just not going to make quite as much money as a West Coast producer could put it down into Japan. That's the really, really lucrative market. But as you say, it's quite a burden on Japan to pay those costs.
Yeah, and as long as Europe doesn't allow shale drilling, right, there's going to be opportunity there to continue to import oil and natural gas into Europe at a big profit, right?
Yes, there will be. I mean, there's a little bit going on. Poland is doing some fracking there, but a lot of Europe has either outlawed it or discouraged it or delayed it. I think the UK is proceeding down the path of trying to do a bit, but Poland had a successful well. They were the first in Europe last year. They had ExxonMobil, I think, pulled out after saying, we just don't see the opportunity. But then I believe it was a ConocoPhillips partnership there that drilled and had a successful shale fracking well.
Well, that's good news then for that area then, because maybe they'll be able to reduce their energy import costs and they'll be more competitive with manufacturing, because I think that's what's brought back a lot of jobs here in the United States is thanks to, the hydraulic fracturing and these oil entrepreneurs that have figured out, new technologies and techniques and things like that with horizontal drilling and hydraulic fracturing. These cheaper input costs for manufacturers and stuff has allowed manufacturing jobs through robots and other stuff to come back, and that's brought back a good amount of jobs here in the U.S. besides the people that are working, in the Bakken and things like that.
Well, it's funny you mention that because a guy just made a comment to me yesterday. He said, because I'd written an article earlier in the week explaining why biofuels have a difficult time competing on price with oil. And he came back and he said, I don't think that's fair. I think that ethanol in the Midwest can compete on price with oil. And I said, one of the big secrets there is the natural gas inputs into ethanol production are substantial in the way of processed steam and fertilizer. So low natural gas fracking is benefiting a lot of biofuel companies, benefiting the ethanol industry. It's benefiting companies like Kior, who are publicly traded. This is one of Vinod Costa's companies. It's down about 90% over the last couple of years. But one of the things that has kept them in business is very low natural gas costs because they use a lot of natural gas. So it's ironic that the fracking revolution has enabled a lot of these companies to stay in business.
Now, about corn ethanol, I wasn't planning on asking about this, but isn't corn ethanol the energy return on energy invested? Isn't it not really a good long-term investment, and isn't it mostly just funded because of subsidies and the corn industry wanting to find another use for corn that it can sell at a higher price than the normal food stuff? Well,
it is very, very political. The energy return is not great. In some cases, it may be below 1. For example, if you have to grow corn in Nebraska and you have to irrigate that and then you end up shipping that ethanol to California, you probably did that at a loss of energy. If you're producing corn in Iowa and consuming that locally, you probably have an okay energy return. It's still not like an oil well or gas well, but it's probably better than 1, everything included, and if you have a good use for the co-products. But as a national energy policy, I've never thought ethanol was a good idea. I think it can be okay. Personally, if I was the governor of Iowa, I would say, corn ethanol is good for my state, and I want to pass laws that make sure that we're using what we're making. So, Iowa, I think, would be well suited to try to incentivize E85 as much as they can and secure their own markets. But I don't think corn ethanol for California or corn ethanol for New York or Florida makes a whole lot of sense. There are other things that make more sense for them.
Yeah, I agree. It's definitely a political market. There wouldn't really be any free market demand because the more ethanol you put in your engine, right, it destroys your engine because engines are not really meant to take ethanol. That's why they only put in 10%. And I hear that they're actually talking about trying to put more than 10% mandate into each barrel of oil, right, before it gets refined into gasoline.
Yeah, the ethanol lobby would like that very much. The EPA did give a waiver where they allowed certain model cars to accept more than 15%. But because it wasn't a mandate and because not all cars are allowed, and because the car manufacturer said, hey, the EPA can say that, but we're not warranting those cars, E15 has not caught on at all. So, the retailers do not want to accept that liability. So short of seeing a mandate from the EPA, I think the ethanol's only path forward is getting E85, building up E85, which makes sense maybe in the Midwest, and then exporting ethanol. I think that's their only route. I don't think E15 is a route for them.
It's a good point. And I think part of this also is to make sure that the corn prices stay at a certain level and go higher because it's kind of like a subsidy to the farmers, extra tax revenues to the states where there's a lot of corn crop growing. Let's transition now to shale oil drilling because that's really the big story. And I think that's kept the U.S. from collapsing economically because it's brought manufacturing jobs back. It's drastically reduced the United States trade deficit, because now we're exporting, finished products, finished oil products and stuff like that. And what do you think in terms of production? Do you think that the U.S. is going to be energy independent, or what's wrong with some of those statistics then with the energy independent projections that you see?
Well, a couple of things. I mean, a few years ago, I would have said that the U.S. will never surpass the peak of 1970. Right now, we're on a trajectory to pass that peak by the end of the decade. And I no longer say that we won't pass it. You learn and you see new things, and I'm not rigid in my views. I modify my views as evidence comes in, and this has been something people did not see 10 years ago. I've joked that I started out riding on the oil drum, and if somebody had suggested on the oil drum in 2005, when we were all talking about imminent decline of oil and natural gas, that the U.S. would be the fastest growing oil producer in the world within 7 or 8 years, people would have just laughed you off the board. And yet that's what's happening. The U.S. is right now the fastest growing oil producer in the world on the back of the shale oil. Now, one of the things that's wrong with statistics is that some of that liquids production is condensed liquids out of natural gas production, and that's not quite oil. It's it's ethane and it's propane and it's butane. Some things that can go into an oil refinery and can end up in finished products, but it's not quite oil. So there's a little bit of misleading information in the numbers, but there is no doubt that the U.S. is producing a lot more oil than we were. I mean, the Bakken, the Eagle Ford, the Permian Basin, those areas are exploding with oil production. And some people rightly point out that these wells deplete quickly in the first year, and this is true, but the counter to that is these areas are not close to being saturated on drilling. And so, a lot of oil wells drilled, production falls off rapidly, but then it stabilizes. It continues to decline, but at a much lower rate. And over time, these areas will be saturated, but I've seen projections that will not happen until early in the next decade, that the Bakken, for instance, will be finally saturated and maybe peak and start to decline.
That's very interesting because yes, there is a large decline curve obviously after the first year, but from what I've read, it seems like after 3 to 5 years that the production rate, some of these shale oil wells can go from over 2,000 barrels per day of oil production initially, and then they drop down to 20 to 50 barrels of production after 5 years. So we haven't drilled enough of these wells yet, right, to test where they are, after 5 years or 7 years, right?
Correct. I mean, we don't have a long enough history to know that, after 20 years, these wells are still producing 50 barrels a day. But, I tell a lot of people, don't discount wells that produce 50 barrels a day. A large fraction of U.S. oil production, something like 20%, comes from those very small, I believe the number was like 20% of U.S. oil production comes from wells producing 10 barrels a day or maybe 50 barrels a day. So they contribute a substantial amount of oil to the U.S. total. Now, this was a few years ago before the shale boom, so it's probably a lower percentage now. But it's there's a respectable amount from these little pumpers that put out 10 barrels a day.
Yeah, the rest of the world doesn't seem as fortunate as the United States because I don't know how long it's going to take to apply that technology, or if their shale deposits are not as easy to frack and get higher production wells out of there. But we're spending globally over $600 billion per year just to keep global oil production flat or slightly increasing. It's only the U.S. shale production that is increasing, like you said. But it seems to me that
okay, you're back. I lost you for a second.
Okay, but it just seems to me that we have rapid depletion rates in the North Sea. A friend of mine who lives in England alerted me that the North Sea has dropped almost 30% oil production in less than 5 years. The depletion rates are enormous there. The Saudis are now going offshore. So it just seems to me like shale has kind of offset some of these other large depleted well oil reservoirs outside the United States in more conventional type of production.
Well, yeah, I mean, most of the increase in oil production in the world over the past few years has come from the U.S. So you're exactly correct. The depletion in all these countries, the U.S. shale boom is compensating for that. And something you said earlier, some of these countries, they have a lot of resource, but the geology is not as favorable. China has a lot of shale gas resource. Argentina has a lot of resource. One of China's challenges is they don't have a lot of water where they have a lot of shale gas resource, and that makes it challenging to frack those areas. The U.S. has some of the better geology in the world. Russia has a lot, and Russia's moving down that path as well. I think we will see the revolution in the U.S. Circle the globe, and there'll be places that do well and there'll be places that don't, but you will see more production start to come online. And people continue to predict oil prices are going to collapse on that basis because the more oil that comes online, it's got to collapse price. But you see the growing demand in Southeast Asia and across every developing region of the world. Demand is growing rapidly for oil, gas, and coal, and this is what's keeping oil prices stubbornly at $100 a barrel.
Yeah, I see demand growing faster than supply. I see it being more challenging to bring on new supply because, like I said, we're spending so much money on CapEx basically just to stay flat or slightly increase. If it was that easy, Robert, to produce enormous amounts of more oil or natural gas and stuff like that, CapEx would be a lot lower, wouldn't it?
Right. I mean, there are companies like Chevron recently announced that their cost of production has gone up significantly. I think it was 56% or something that their cost to produce a barrel of oil has gone up in the last few years. So yeah, it's a lot of these. I mean, this is why oil prices won't collapse. I mean, there's people every year predict we're going to $50 this year. There's not enough marginal production at $50 to support production. So what would happen is if oil price $40, you'd see production collapse, and then prices would spike right back up. So the shale boom is putting a floor. Now prices could always drop to $50 in the short term. You know, we saw them in 2008 fall into the 30s, which I said at the time there is no possibility this is sustainable. And so the price popped back up. But you won't see $50 is not a sustainable number. And this is a funny thing about, you know, one thing about peak oil and the discussions about peak oil that I've had with people, we probably have passed peak $50 oil. So the oil that could be economically produced at $50, that is in decline. Certainly we passed peak $20 oil. But peak $100 oil, we haven't passed that yet. There are enough plays around the world that we can continue to grow production for a little bit longer at $100. If oil was $200, we'd grow production even faster. There is, of course, a limit. You can't grow this forever, but peak oil is very much a function of price, and this is the factor that I think many of the peak oil proponents missed years ago, is that the way that price will incentivize developments like fracking.
It's a very, very good point, Robert. And I call it peak cheap oil. And I think oil, I predicted this in the Petro Profit Report, which I co-authored with John Manfredo, a mutual friend of ours, a couple years ago. I think oil is just going to stay in a pretty wide trading range for the next couple years, where I don't think it's going to go below a certain number, maybe $65 or $70 a barrel for WTI, because that's below the production cost for the shale oil producers. They can't even hedge a profit at that point.
Right, and I've predicted the same. For the last couple of years, I predicted that oil will probably trade in a range that could drop as low as $70, and it could trade up to $120, but any major disruption around the world will spike that to the high side. The spikes won't be to the low side. The surprises will always be to the high side. And once we break out of that $70 to $120 trading range, it will be to the high side. So long term, I'm bullish on oil production. I have been for years.
Exactly. And if we look at the data for auto sales and scooter sales and motorcycle sales outside the United States and the developed world, in the developing world, those numbers are still increasing rapidly. I believe China is putting 20 million new cars per year on the road. So that is an enormous number.
Yes.
Now, let's talk about the refiners and the pipeline companies. Do you think the refiners, they were one of the major surprises in the last 18 months. Refiners as an investment had been absolutely hated for a very long time. There's a lot of EPA issues with them. Do you think they're going to be able to still profit off the cheaper shale oil, or do you think there's going to be more challenges ahead for them?
Yeah, refiners are I'd never recommend refiners as a long-term buy and hold investment. I could recommend a lot of oil companies as long-term buy and hold, but refiners are so much more cyclical that I really tend to watch the spread between, say, WTI and Brent crude, because refiners in the U.S. are able to buy crude at prices sort of reflective of West Texas Intermediate, but the finished product pipelines can get all that to market and to waterborne markets, and so the finished products are more reflected by Brent prices. And over the past few years, there's been a huge gap that opened up. You know, historically, WTI was actually slightly more expensive than Brent, and because of the shale boom and the lack of infrastructure, WTI prices got very depressed. I mean, at one point, they were over $20 cheaper than Brent prices, and so refiners did very, very well. And so I've had investors in and out of refiners over the past 2 years at different times. Last year, we advised people to start pulling back when that spread started to decline. And then in summer, it bottomed out at below $5. And all the major brokerages at that point were telling people to sell refiners. And that's the point I said, I think it's time to buy. And we flipped back over and told people to buy Valero, Tesoro, those refiners, because we felt like that low spread was not sustainable. I think in the longer run, that spread will sort of be $10 to $15, which is pretty good for the refiners. A spread below 10, which has been for the last month or so, and you've seen refiners soften as a result. That's sort of my benchmark. If the spread's above $10, I think the condition is going to be pretty good for refiners. If it's below 10, it's not going to be as good. And I watched the spread versus the spread at this time last year. So this quarter, for instance, a year ago the spread was still at $20, and right now, a few days ago, it was at $8. So this quarter is going to be worse for refiners than the quarter a year ago, but the spread is starting to widen back out from what it was, say, a month ago. It had shrank back down to, it got close to $5, but it looks like it's growing again. So, the refiners are just one for me, for short-term traders. If you want to trade in and out, you watch those spreads. And sometimes the market is reacting immediately and sometimes it's not. And that's what you want to watch. If the spread, to me, gets to $15 and refiners haven't really responded, it's a really strong buy signal for the refiners in the short term.
It's a very good point. That's great analysis there about the refiners being just short-term trades or maybe swing trades or things like that, not long-term investments. Although I think for Brent, I think there's going to be CapEx challenges more than here in the U.S. for the shale oil drillers, because the shale oil drillers are just getting what they're figuring out new ways to slightly lower their costs as compared to the Brent crude production, which is conventional. A lot of it's deep water offshore, oil sands and things like that, and the capex for those are just monstrous as compared to some of the shale oil drilling, which has a much faster payback period, right?
I agree, and this is also very good for infrastructure builders and rail companies, because while the price point is very attractive and production is exploding, they still got to get that oil to market. So one of the companies that I recommended a year ago was American Railcar, because they had such a huge backlog of due to moving oil by rail, and that has exploded this year. American Railcar, they sharply upped their dividend and announced record quarter, and they are up sharply. Now they're a little expensive at this point, so I wouldn't go rushing into them right now. But a year ago they were looking relatively cheap still to me, even after a big run up. And they've had another big run. And then there's the infrastructure builders, lots of pipeline companies, lots of master limited partnerships that will benefit greatly from this continued build-out of infrastructure.
Yeah, and that transitions me to my last question that I had for you, and this was just basically about the Keystone XL pipeline. Why do you think then that people, the environmentalists or whoever, the mainstream media message is saying this about pipelines when it's clear that the evidence that the rails are more dangerous to transport shale oil, because we've had, these accidents in Canada, in Quebec, we've had explosions of rail cars. Why do you think then that pipelines aren't being approved? Because you wrote this great article about pipelines a number of months ago, right, saying that, people don't realize we have all these miles and miles of pipelines, and people are making a big deal out of a small pipeline compared to the total pipeline capacity we have in the United States.
Right. The amount of miles of pipelines we have is like 50 times the length of the interstate highway system. So underneath the U.S., there are pipelines running everywhere. So you ask the question, why are environmentalists then protesting the pipeline when rail is more dangerous? Because they think that by shutting down this pipeline, they don't believe it's going to go by rail. They believe that by shutting down the pipeline, they're going to shut down production. Now, I've argued that's a very naive view, and that history has shown how quickly, and in the Bakken, essentially, we built a keystone on rail. I mean, the rail transportation went from almost 0 to 700,000 barrels a day in 3 years. So almost the capacity of the Keystone Pipeline on rails, because the demand was there. The oil differential was cheap between where it was being produced in the Bakken and what you could get for it on the coast, and so the rails came in and they responded. And that's what always happens. And I've given interviews on this before, and they say, what is really going to drive production of the oil sands? And I said, it's going to be the price of oil at the coast. That's what's going to drive that. And the price that you can produce it for in the oil sands. So if you can produce oil sands, a barrel of bitumen, for $30, and the price on the coast is $100, rail is going to respond, pipelines are going to respond, people will be putting it in trucks to take it to the coast. And that's what's going to drive it. So if you really want to shut down Keystone XL, you've got to shut down the demand. I mean, the war on drugs never worked because the demand was always there. You can't shut down the supply if the demand continues to be there. It just makes it more lucrative, the trade more lucrative. So, I've argued that the protesters of Keystone, they're really focused on the wrong problem. The real problem of carbon emissions, China and India and Asia Pacific in general, their emissions from coal dwarf anything from oil. All the oil sands is just dwarfed. It's just noise compared to the carbon emissions from coal coming from Southeast Asia.
Oh, yeah. I've seen the pictures. I don't know if you've seen some of these from Bloomberg and other stuff, traveling around China. I've seen the pictures of the smog in the cities and the people with the mask over their head or towels and stuff like that just going to work every day.
Yep.
So they're getting asthma and a lot of other, disgusting type of, well, I have asthma, but a lot of other respiratory problems, really sensitive stuff.
Yep.
It's kind of like the reading about the London Industrial Revolution where, you had the London fog and you couldn't even see 100 feet in front of you.
This is why China in the long run is going to just continue to build out nuclear plants as well, because they're going to say, for the long run to clean things up a little bit, nuclear, that's really going to be the story of nuclear over the next 30 or 40 years.
So you don't think then that Fukushima will be the death knell for nuclear? Because obviously at some point Japan and Japan and South Korea are going to have to make a decision because they've turned their nuclear reactors basically offline. So they're going to have to figure out then, are we going to run trade deficit? Well, South Korea's not running trade deficit, but Japan is now. Are we going to run a trade deficit and risk collapsing our economy, or are we going to have to find another source of cheap energy or go back to nuclear?
Right, and that's exactly the decision. Some countries like I don't think Germany is going to turn their nuclear plants back on, and so they're going to be an interesting experiment to watch.
But they import the nuclear energy from France, though, right? So that's kind of hypocritical because they increase their imports from France, right, of nuclear power.
They do, and there's certain ways they compensate, but they show what happens when you shut down your nuclear. Other things have to take its place, and it's not as cheap and it's not as clean in a lot of cases. You've got renewable power that tends to be more expensive, and then they're turning back to coal, which is not as clean. So a country like China, though, I think their decision is going to be, we can do nuclear, we can do it safe. Other countries are going to say, we're just not going to go down that path at all. I think in the U.S., it's give us a few years. I think we'll be talking about nuclear again and maybe thinking about putting some new plants online. But right now, Fukushima, it sort of did what Chernobyl did. Chernobyl, the nuclear build-out in the world was growing exponentially, and Chernobyl, you can see the real inflection point on the build-out of nuclear capacity. And Fukushima's done the same thing. There's been a real flattening of capacity. And I think give it a few years and you'll see that start to tick back up.
Yeah, this would probably take more than a decade to implement this solution, but I wish governments like the United States and China, well, China's already doing this. They're putting more than $1 billion in, but I wish they would really put the money into the liquid fluoride molten salt thorium reactor, because I've watched documentaries and read about it, that it's walk away safe, but it's not ready to be scaled up.
Yeah.
They ran that reactor at the Tennessee Valley Authority, I think.
Yeah.
And they ran it for 3 years continuously, a test reactor, but then the plant lost all of its funding and it got decommissioned, and the Chinese got all the intellectual property for free.
Yeah.
So from the U.S. It's just a really sad situation, because I think that's probably the safest form of nuclear I've looked at, but they don't have any of the stuff they need to start, building these reactors, cranking them out every couple months and just building them and stuff like that. We're not there yet, unfortunately.
Right.
Okay, well, Robert, that was a great discussion. Gone a little bit longer, but could have talked to you for a lot longer about the energy markets. It's something I really enjoy. There's a lot of interesting things, and there's so much politics around the energy markets because it's the biggest market, right? That's where all the money is.
Right.
So, thank you for coming on a podcast, and please tell our listeners more about where they can find your work.
Yeah, I've got a couple of homes. I write several columns for Investing Daily. I write on Master Limited Partnerships. I write a column called The Energy Letter. I write a subscription column called The Energy Strategist. And then for just more general energy discussions, I write a column at Energy Trends Insider. And that's where I'll write about topics that don't necessarily impinge upon finance, although almost everything in energy does. But it's not specifically focused on financial impacts. It's focused more on just the broader energy markets. Like the article I wrote this week about biofuels and why they tend to be more expensive. That column is for just explain to people how the energy markets work and different things about energy. whereas the ones that investing daily have a specific investment focus.
Okay, well, thank you for coming on a podcast again, and hopefully we'll have you back on soon for more energy market analysis.
You bet. Great talking to you.